Day like Bloomberg. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on Wednesday, October 26th. Here are the top market stories that we're following for you at this hour. Toasted tech, Alphabet and Microsoft dragged down their peers after reporting slowing growth. You got Facebook on tap. And whatever makes the Fed happy, rough tech results, rough economic data. Is this really Goldilocks for the Fed? And inflation is the enemy. UK Prime Minister Rishi Sunak talks tough against rising prices and pushes back next week's fiscal statement. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, just to point out how bad tech is performing today, you're taking a look at Microsoft for the S&P. It's taken out 17 points on a 17 down day for the S&P. For the Nasdaq 100, it's taking out about 93 points. This is really going to weigh on the overall indices.
You put Alphabet together with Microsoft. These are big losses individually. You put them both together. Ouch. We're also getting some news from the Bank of Canada, which I think is worth paying attention to. You can think about this maybe through the Australian lens as well. The Bank of Canada has just delivered a 50 basis point hike. The market was expecting 75. The BOC, Tiff Macklin, saying we will need to raise further given high inflation. Now, he was pretty hawkish on inflation, the governor, a little while ago. So why have they gone with the 50 is the question. And when the market expects 75 and you get 50, is that a pivot? I think we need to define pivots and exactly what a pivot is these days. Maybe we're getting into a scenario, and we need to think about this through the Fed's lens as well, of a world where actually we front-loaded aggressively, and now we start to slow down the rate hikes, the rate of rate hikes. And I'm wondering how the market's going to kind of react to that. But it's interesting to see the move that we're getting. Well, not huge, but we've got 50, Alex, not 75.
Well, actually, and we are seeing a reaction pretty much across the curve. You're seeing lower yields. So the idea is that, yep, you're seeing some buying coming in, lower yields, particularly in the front end. We're now at 4.4 for the 2 years. So, but does that constitute enough of a pivot to warrant a real reversal within markets? Here's one area of data point as well here. So new home sales actually down just 10.9% for the month of September on a month-on-month basis. We were looking for negative 15. We got negative 10. So it's still bad, but not as bad. What does that wind up meaning then for the Fed? Does that mean we're seeing some stabilization in housing, and that's a good or a bad thing? I think understanding the reaction function to the data is quite difficult.
Yeah, and this has been a data series that's been all over the place. We got that plus 28 last time around in August, which was just weird. Yeah. And we didn't quite understand what the implications of that were. So maybe actually the new home market is holding up a little bit better than anticipated. As you say, this data is much better. The range, I have to say, was negative 30, this is the month-on-month number, to 2.2. So a huge range in terms of that data, Alex. And we've come kind of, as you say, to the more positive end of that spectrum.
Yeah, but rates, 7%, 30-year fixed, ouch, that hurts. Okay, so let's pull all this together. That leads us to our question of the day. Bad earnings plus bad, maybe we'll put in air quotes, data, equals happy Fed. Well, joining us now to break it down, Bloomberg Stocks reporter Jess Menton and Bloomberg International Economics and Policy correspondent Michael McKee. That just goes even further to the whole bad news is then good news if you're a stock investor or if you're a Fed governor. What do you think?
Well, yeah, that's probably the case. The Fed is looking for signs that demand is slowing, and they're getting it to a certain extent in the new home sales data and some of the other data that we've gotten over the past couple of days. The Fed obviously affects real estate more than anything else, but new homes are a little bit tricky because they're based on contract signings a couple of months ago and not on, they're based on contract signings now and not on what's going to close. So there may be some of these canceled, and also builders have backlogs. The disturbing data in the new homes numbers is the median price jumps to $470,600 from $435,800. That is not what the Fed wants to see, because this home prices continue to feed with a very long lag into CPI, and it's just going to keep the pressure on.
Jess, that's the data. Let's fold in the earnings. Up until now, this earnings season has gone relatively well. Does tech change that? Does tech change the whole characteristic of how the broader market is going to perceive what is happening with corporate reporting?
Well, we're already seeing that today. And when you're talking about technology stocks and also growth stocks, they are a big chunk of the S&P 500, close to about 20% to about a quarter of that. So when you see those moves in the stocks, especially when you had companies like Microsoft and Alphabet reporting after the bell yesterday, and again, Microsoft posted its weak quarterly sales growth in 5 years, and that company did already warn about the strength of the U.S. dollar over the summer, and again reiterated that, and especially also looking at Alphabet. I mean, when it comes to its most important financial engine, when it comes to search and its related businesses like that, its sales did fall shy of analyst estimates, and that is coming ahead of Facebook's earnings after the bell today, and then we'll also hear from Apple tomorrow as well as Amazon. And so that's going to be really crucial when you're looking at technology and growth stocks, because even though a lot of that seemed to be priced in on the earnings side of things, I was talking to Gina Martin Adams and her team over at Bloomberg Intelligence, and they still think that there could potentially be more pain to come on that side when we are talking about technology stocks.
Well, but also, Jess, what I found interesting too, to Guy's point, is that some of the consumer-driven names, like Heinz, like Coke, et cetera, they're passing along their price increases, and like it seems to be working. Tech is sort of a beast unto itself, but they've also re-rated enough. Have they re-rated enough?
It's interesting because when you look at, say, what's happening with staples companies, even on the margin issues that those companies have seen, still holding up more broadly better than expected. I think a lot of people were thinking there was going to be this big earnings reset. Say when we first started getting second quarter earnings reported in July, that didn't necessarily happen. And I was talking with BNP strategists, and they still think that it's going to take a few quarters for this margin story to play out. So even when it comes to, say, technology names, that's a big key area as far as what that means. Even though inflation can help their revenues in certain regards, you also still have to deal with the grappling with the stronger U.S. dollar, especially when you're talking about S&P 500 companies, and especially technology and growth stocks. Usually about close to 40% of them derive their revenues from overseas. When they have to translate that over, they are essentially losing money. So that's going to be a big thing as far as crimping profits when you are looking at what happens with the margin picture with technology companies.
It was interesting. We were talking to Mark Stokel yesterday, and he was saying that he thinks that names like Coke are probably reaching the limits of their ability to pass on prices, to pass on the cost that they're seeing into prices. Mike, let's pull this all together. Let's talk about the Fed. Just seen the Bank of Canada go 50 rather than 75. What will the Fed read into all of the data and the earnings that it's seeing right now?
Well, it gets complicated, but I think because the Fed has its quiet period now, blackout period, and they can't send any signals unless they really want to make a big change. If we don't hear from the Wall Street Journal on Monday morning that the Fed is going to do 50, they probably are going to stick with 75. Now, will be interesting to see when Tiff Macklem has his news conference what the justification for slowing is. It does look like they have downgraded their growth outlook at the Bank of Canada. But in the U.S., we are seeing, because the market has started to rebound, we're seeing financial conditions ease again, and that's not what the Fed wants to see. So 75 basis points might be not just an effort to get to the level that they figure they need, but also a message to the markets that they shouldn't work against the Fed at this point.
But at some point, are they going to be working against other central banks? Like, is a hawkish, a dovish 75? Maybe more in the cards right now than it was last week?
One of the things that they have talked about is the fact that because everybody is raising rates, it tightens global financial conditions. And so they may not need to do as much. It's kind of hard to get a precise estimate of the impact on the United States. But of course, you've got the Bank of Canada today, then you've got the European Central Bank tomorrow. Then we have the Bank of England coming up first of the month. So you're going to be seeing people raising rates even further, and that will have an impact somehow on the United States. And so if the Fed thinks it's going to go too far by raising 75, they might want to back off. But because they've set the predicate of 75 this time and then we'll take a look around, that is probably what they're going to do so as not to surprise the markets.
Guys, we're going to wrap it up there. Really useful, really useful on a day when we've got so many different moving parts coming into the story. Jess Menton, Mike McKee, thank you both very much. Okay, what have we got coming up for you? We're going to carry on the conversation more relating to our question of the day. Bad earnings, bad data, happy Fed. Erin Brown, PIMCO Portfolio Manager next. This is Bloomberg.
earnings season is here.
The earnings are starting to pour
The
in.
numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going to cross the wire.
Big beat. Stock is up more than 8%. Coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch? That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Ultimately, the bear market will be over probably sometime in the first quarter. Now, all of this is, subject to revision, right? So I want to make it perfectly clear, if the market starts to trade off again and the S&P breaks down and blows through 3650 on the downside, we'll be bearish again.
That was, of course, Mike Wilson, Morgan Stanley, earlier on Bloomberg Surveillance. He's talking about potentially the end of the bear market, as we just heard, in the first quarter of next year. Now, he's willing to be wrong and he's willing to change that call, but that's kind of the central case right now. Our question of the day, bad earnings plus bad eco data equals happy Fed, i.e., are we getting close now to the bottoming process? Aaron Brown, PIMCO Portfolio Manager for Multi-Asset Strategies, joins us now. Q1 next year, beginning of next year, do you think that's when the market bottoms out?
I don't think it's going to be the beginning of next year. We still have to get through what I think is going to be a difficult fourth quarter earnings season. So we'll get that early in the year next year, and then we'll see, I think, the fallout from, weaker earnings, downgrades to earnings growth, CapEx growth, and that should play out through the first half of the year. I do think that, that will likely be realized some point in the first half of the year, but I wouldn't call it as an early first quarter trade where we'll see the bottoming out.
Hey, Aaron, do you think that the Fed looks at these earnings numbers, if they do at all? And is this what they want to see? The rolling over of the high, really growthy names?
I don't think that they're pouring through earnings reports, but I think that they are looking at just generally how the market's trading and the feed through that has to financial conditions, because ultimately, a rebound in equities is in some ways hurting their measures on tightening of financial conditions, and they're still in an environment where they're trying to tighten financial conditions. So certainly they're watching it as a way to understand, how that will move through to the indicators that they care about, but it's not something that they're sort of pouring through on a day basis like many of your watchers on Wall Street.
Yeah, we're certainly pouring through them with a great deal of detail. Let's talk about those tech earnings then. Look, Aaron, we've had a decent bounce over the last few days for equities. Do you think ultimately tech brings that rally to an end, or do you think it can sustain itself through some pretty poor earnings from the tech sector?
I think it's going to be really challenging. Firstly, tech is the biggest sector in the S&P 500. It's about a quarter of the S&P 500. Secondarily, what I think tech is highlighting right now is in some ways a canary in the coal mine for the broader markets. They're talking about weaker ad spend and weaker CapEx spend and weaker demand as well. That's seeping through from the consumer side over into the industrial side. And to me, that's the first early indication that we're seeing that enterprise is really weak, and we're seeing it come through with companies slashing their CapEx budgets and slashing their ad spend.
So if you just take a look at tech specifically, a NASDAQ 100 trading near its average over the past 10 years, does that mean that, it can go lower from here, or does that mean that we may be in a bottoming process once we get through these earnings numbers?
I don't think we're at a bottoming process yet. I think that this is the first leg and a necessary sort of step that we need to take, but we need to see much more widespread earnings degradation and downgrades to consensus estimates for next year, as well as a resetting lower of margin expectations. This is the first step. I think the second step is going to come through in the fourth quarter earnings season, and then we can start to see some price discovery and a bottoming out in the markets, but we're still a ways, from that right now.
Aaron, we've just seen the Bank of Canada go 50 bips when the market was expecting 75. How do you think the US equity market reacts when we get to that point for the Fed, where it stops going 75 and starts going 50?
I do think that pivot, if that's what you want to call it, will be, a positive catalyst for markets. But, the Fed is going to be moving down to 50 basis points at a point when they start to see, more significant economic weakness on the horizon. And so, it's a little bit of a careful balance because while the Fed is slowing, they're certainly not pausing and they're nowhere close to cutting rates. And so I still think that the equities will trade down. You may get a little bit of a relief rally on the news, but I don't think it's going to be an all clear signal for equities.
So Erin, on that, if we get a relief rally, what do you do with it?
I would fade the relief rally. Right now, over the last week or so, we've been resetting shorts or underweights at, sort of higher levels, taking that as an opportunity to get more underweight stocks. I don't think yet that we've received that all clear signal. So I think you respect the rally, but look to reset shorts at higher levels.
Erin, let's talk about how the U.S. equity market fits into the global picture. The Stoxx 600 in Europe is now trading on 11 times. We're getting down towards 10 times, which has been a big buying opportunity. Other markets potentially around the world may be getting into the bottoming process. How do you need to, as you think about portfolios, how do you need to think about what is happening more globally and how you plug in your equity positions in the States to that?
Well, so first thing, I think it's important to sort of look at what the underlying earnings assumptions are for that 11 times or 10 times earnings multiple. The Euro Stock Index still has embedded expectations of close to double-digit growth next year. I think that's still too high, and I think that the margin expectations of expansion there are about 60 basis points, which is, pretty extreme in an environment where you think that Europe is heading into a recession. It should be probably negative 50 basis points. So firstly, I think that those 10 or 11 time numbers are overstated. But then I think more broadly speaking, we're in a global growth slowdown market. And so in that market, you really want to be focused on the less cyclical aspects. U.S. generally has been less cyclical than the rest of the world. So on a relative basis, it can perhaps do better. But I still think this is on an absolute return. You're going to lose money in equities. You're going to lose money in Euro stocks and in emerging markets over the next sort of 3 to 6 months.
Erin, where do I make money then?
I still think that defensive's healthcare sector looks really attractive. I think certain commodities like energy still look attractive in an environment where supply is constrained. Similarly, some of the agriculture sectors also have significant supply constraints. So I do think that there are sectors, but you have to be very specific in your stock selection and look for earnings that can continue to grow in absence of strong or nominal GDP growth.
All right, Erin, thanks a lot. We really appreciate it. Wonderful to get your perspective. Erin Brown and PIMCO, thank you so very much. Still ahead, we're going to dig into tech more. You got Microsoft, Apple dragging markets down. More on that Microsoft number and the lackluster forecast next. This is Bloomberg. right, shares of Microsoft down more than 18% today after its sales forecast fell short of estimates. The tech giant posting its slowest growth in 5 years. Joining us now is Anurag Rana of Bloomberg Intelligence. Anurag, were the numbers worth the kind of slide that we're seeing in the stock today?
So I think you have to remember that for the last few years, Microsoft has been deemed as a growth stock. So when that growth dips below the last few year average, I'm sure some of the growth investors are saying, you know what, we will revisit this story when the growth goes up to double digits. Till then, this is more of a GARPy name for growth at a reasonable price.
Anurag, let's talk about whether this is the kitchen sink quarter or whether or not we see this enterprise weakness bleeding into the next quarter as well. Is this going to be something that we're going to live with for a while?
Yeah, I think this is going to happen for at least the next 2 to 3 quarters, because typically what happens is you have, tech budgets going in, and when people start to hold back, they just don't reverse it immediately. Unless we see a massive pivot from the Fed or signal that inflation is really low, that would increase business confidence, I think we are not going to see tech spending bottoming out anytime soon. I think it's going to be more of a slowdown in 2023 and then a bounce back in 2024, and a very strong bounce back in 2024 then.
Okay, so Anurag, what kind of growth qualifies Microsoft for a growth rating in the market?
So the way we want to think about it is tech spending grows in somewhere around 5 to 6%. Software spending grows around 10%. And Microsoft has done phenomenally well at 16% constant currency growth rate for the past 3 to 5 years. Now, when you look at it this quarter, they again, grew at 16%. But next quarter, they're going to hover around 8 to 9% and somewhere in that range. And that number is the one that is, I think, causing a lot of distress. In our view, it needs to get up to that 12, 13 number again before we can call it a growth stock again.
Did this come as a surprise, do you think, to management? This hasn't been particularly well communicated.
Yeah, I mean, it did come as a surprise to me, frankly, because I was expecting the growth to slow down, but somewhere in the 10 to 12% range, not around the 8 to 9% range. And I think the biggest thing for me was not actually the cloud numbers, which I think everybody is harping upon. I think the bigger issue was the PC slump down, which I think everybody has talked about, but I don't think the numbers really reflected that going into next quarter, they could see a double-digit decline in that business unit. For me, that was the biggest surprise. Now, as far as the cloud is concerned, and we saw this during the pandemic, we did see dip in cloud growth rates for next 4 quarters when, the pandemic started. But then what we saw the year after that is a massive bounce back. So for me, cloud is something exactly what I expect going forward is the next 2 to 3 quarters a bit slow down, then after that a big ramp up, because the end markets there are too big to ignore, frankly.
Well, what about the cost side? So what I also find really interesting was how they highlighted specifically higher energy costs in Europe and hinting that it's not necessarily a cyclical thing, that it could go on for a while, like it's not just for the winter. What did you make of that as it related to cloud services?
Yeah, no, I to be honest, we were expecting that, and I would credit Amazon Web Servicing for highlighting that first time in the last time they reported, which is no secret. I mean, these companies run massive, thousands of data centers out there around the world. And if you see energy costs in Europe rise quite a bit, it does have an impact on the gross margins of cloud computing and then, eventually operating margins. But frankly speaking, I mean, in my view, it also helps companies, enterprises around the world that run their own data centers. They need to think about if they can move their data, if they can move their data center and workloads to the public cloud services, they will eventually save costs. So I think it could actually drive growth in the long run as well for them.
Interesting.
Anurag, always great to catch up. Really useful analysis on what is happening here. Feels like a bit of a pivotal moment. Anurag Rana, Bloomberg Intelligence, thank you very much indeed. Up next, we're going to pivot back to the housing market. US mortgage rates topping 7% for the first time in more than 2 decades. The sales of new homes in the United States dropping as well. We're going to be speaking with a house builder CEO, John Fish, Suffolk Construction, joining us next. This is Bloomberg.
We're about an hour into the U.S. trading session. It actually looks like we're turning around here. Bloomberg's Abigail did a little tracking those moves for us. Abigail?
It does, Alex. It's going to be interesting to see whether or not we go green here for the S&P 500. Most likely, we could be looking at a 4-day rally for the S&P 500. Let's see, though. Right now, fractionally lower. The real divergence here has to do with tech. Microsoft and Alphabet really weighing on the tech indexes, as you can see here with the NASDAQ 100 down 1.2%. There's Microsoft itself. The worst day going all the way back to March of 2020 on the disappointing quarter, the outlook more so. But take a look at the Bloomberg Dollar Index. It's down in a big way for a second day. That, of course, is fuel for a risk rally. So again, it would not be surprising to see the S&P 500 flip higher relative to those results from not just Microsoft, but we're also talking about Alphabet and Texas Instruments. Relative to the outlook, it really is not so great. The midpoint for the calendar fourth quarter outlook for Microsoft and Texas Instruments about 6% below than where consensus is. Alphabet actually not providing that. So again, there's a worry that there could be some sort of an earnings recession ahead, even for big tech. Right now, overall, the S&P 500 is there with about 30% of the companies reporting earnings down about 1.9%. On the other hand, what is helping out stocks and could bring the S&P 500 to join the Dow and the Russell 2000 higher. Take a look at this. We have actually, these are the S&P 500 futures over the last 5 days. So here you go, up 5.2%. This was the best stretch since early March, from March of this year. Another extension of it potentially on the day. And then finally, if we take a look at what is beneath the surface, here are those yields. They are falling, so that again is fuel for the risk rally, bringing that Bloomberg Dollar Index down, helping out all assets denominated in dollars, except for big tech right now. And then finally, if we go into the Bloomberg terminal and we see what's working here, this is the equal weighted index versus the regular. So if you didn't really take a look at the big weakness for some of those big techs, a lot of other stocks, Guy, in the S&P 500, well, they are higher. So again, it's going to be interesting to see whether or not the bulls can pull out another up day.
Yeah, it's basically tech versus everything else. Abigail, thank you very much indeed, Abigail, on what's happening in these markets. Now, earlier this hour, we found out that sales of new homes in the United States fell in September. The data are actually a bit better than anticipated, but it does continue broadly a downtrend that we're seeing in U.S. housing. We're seeing decade-high mortgage rates. We've got 7%, north of 7% now. That's a 20-year high for U.S. mortgage rates, 30-year mortgage rates. Here to talk about how home builders are reacting, digesting to this news, John Fish. He is the chairman and CEO of Suffolk Construction, a national home and building construction firm. Great to have you on the show. Thank you for the time, John. Let's talk about the medicine. The medicine is higher interest rates. Is it working, and does the market need any more?
It's a pleasure to be on the show. I really appreciate that. It absolutely is working. What we're seeing right now, the prescription the Fed has applied is affecting the patient quite substantially. I think when you talk about housing starts, housing sales, rentals, and all the things that go across our category, they're being impacted by higher rates. As you pointed out, we've gone from 3% to 7%. And no doubt November 1st, November 2nd, we're going to see another 75 basis point jump. But at that particular point in time, we're going to have another 2.5 to 3 months before March where we see what the Fed is going to do. I'm just hoping the Fed tempers what they're doing, that they don't overstimulate the rates today we're currently dealing with, because that could put a very, very hard landing on our industry and the economy as a whole.
Hey, John, what does a hard landing for the housing market look like?
Well, at the end of the day, what happens is mortgage rates get to a certain point in time, people just fundamentally can't afford a house. And what's happening...
But we're not there yet, you don't think, John?
I don't think we are there yet. I think the 7% doubling has gone pretty substantially higher than one is expected, but I think at the end of the day, there's still people out there buying houses. It's slowed down. The consumers still have money in their pocket at the end of the day to spend. But at the end of the day, this is not sustainable. And in fact, also what it does, it impacts cost of housing as well, to the building side of things. We can't continue to supply housing at a cost that people can't afford. And I see that's what's in the future right now.
Is this 2008, do you think, John?
I don't think it's 2008. No, I don't. I think the economic criteria are totally different right now. And I think the balance sheets of different organizations and credit is still out there, as Brian Moynihan talks about. The consumer on the marketplace, does have good credit. So to me, at the end of the day, what I'm hoping for is that we sort of go slow to go fast. And in addition to that, from a macro point of view, we have even a bigger problem because housing is such an important issue to our economy. We have about sort of a shortage of about 5 million housing units out there right now. We're only producing about a little over 1 million. And that is a significant problem for the long term.
So, but isn't that also then making the Fed's job harder? Because as you pointed out, no matter how high they raise rates, there's just not enough homes. The demand's still going to be there. And isn't that sort of part of the crux of the problem?
It is, but I think from a long-term perspective, we've got a policy problem right now in America, okay? The issue of NIMBYism, okay, and aligning incentives in different local towns and municipalities to encourage smart growth, housing growth, is not there in line. And I'm hoping as we go through this period of time over the next 12 to 18 months, we can reflect upon some of the policies that have worked and some of the policies that have not worked. And right now, this is an opportunity for us as a country to correct that.
Okay, John, let's talk about the supply side reforms for a moment that you think are required. What do you think does work and what doesn't work?
To me, on the supply side, I think what we need to be thinking about at a high level is that there's a tremendous demand out there for that. But in order to accomplish, I think, what we're looking for right now, we need to have good policy to support and encourage smart growth and smart development. And currently right now, there's a vacuum at that particular point in time. And I think as we move forward through the economy right now, as things are slowing down, it does give us time to reflect on what good policy is going to be on a going forward basis.
So I guess I'm still confused as to what would be the best case scenario where you keep it affordable, but you don't want to create another artificial housing boom, but you're still incentivizing enough construction. I'm still not clear as to what that policy looks like and what mortgage rate echoes that.
Yeah, I think what's important right now is that we have a situation that's not sustainable, that people cannot continue to afford housing where the rates are going right now, and people cannot afford to build housing. So we need to have some type of economic event that slows things down, short-term pain for long-term gain. Once rates get reestablished to a norm, and where those rates are 4 or 4.5%, but not 7 or 8%, that's going to encourage investment in housing on a going forward basis. In addition to that, I think what's happening is on the policy side of things, which is, I think, is one of the biggest issues. How do we incentivize real estate developers around the country, both from an entitlement point of view, a sense of certainty, and also the idea of good policy in local communities and have a sense of predictability that they can in fact build this housing at the end of the day.
John, you're a national builder. You build in New York, you build in Dallas, you build in Florida, you build in California. What are you seeing geographically right now? What are the differences in those markets?
Well, we're seeing a slowdown across the board, but I would highlight right now that areas, I would say, in the Texas region right now, in the southeast part of the country, continue to have a lot of vibrancy in them. And I think the reasons why, because of policy in those particular areas, both entitlement policy and tax policy sort of drives those particular economies. And we all know that real estate is probably about 4 to 5% of GDP. So it's a significant impact on those local economies. And when you have good housing policy and you have good infrastructure, like in Texas and Florida, because we've seen massive investments over the last 10 years or so, people are going to migrate to those particular areas, and that's exactly what we're seeing.
Hey, John, before we let you go, if you were going to be building a house right now, can you get the labor and can you get the stuff to do it? What's your supply chain looking like?
You can get it. The supply chain has improved. There's no doubt in our minds. But still, because of the geopolitical issues, we're still challenged because of China, and we're bringing back things to the United States that are becoming more complex. We're having a war that's causing problems with energy. So the cost for housing is still escalated because of the shortage of labor and the cost of materials at the end of the day. So as we slow down in the housing market, where we reestablish a new equilibrium, what I think you're going to see is housing costs come down over the next 12 to 18 months. Not considerably, but they'll be more stabilized and more predictable. And I think that's what real estate developers and that's what the consumer is looking for, predictability. And we haven't had that sense of predictability since the advent of COVID.
Right, to kind of reset that equilibrium. Great stuff. Really appreciate it, John. Thanks a lot. John Fish, Southwell Construction Chairman and CEO. All right, coming up, going back to tech, we got the global ad slump hitting Alphabet. We knew it was coming, but we're going to take a look at what that spells for Meta's results. They're going to be out after the closing bell today. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. New British Prime Minister Rishi Sunak has delayed an economic strategy announcement that was due to be delivered on Monday. It will now be released on November the 17th. Sunak seeking more time to make what his office calls the right decisions on managing the British economy. The government is seeking to plug a fiscal hole of more than $40 billion. President Biden congratulated the new British Prime Minister Rishi Sunak in a phone call. The two discussed the Russian invasion of Ukraine and challenges arising from China. The two also talked about the unresolved issue of the Irish border after Brexit. And Europe is running out of time to act on natural gas before winter. The bloc still can't agree on what a price cap should mean. Policymakers have gotten a break. There's a glut of gas in Europe, thanks in part to warm weather, but that's caused a sense of urgency to fade. And a new report from the United Nations paints a grim picture of global warming. It says Earth is on track to warm by more than 2 degrees Celsius by the end of the century, despite plans to cut greenhouse emissions. The UN says the good news is that projections show emissions won't increase after 2030. And New York is still the most expensive rental market in the U.S., but Boston has now passed San Francisco for second place on the list. According to rental listing company Zumper, the median one-bedroom rent in New York is now $3,860. Boston rose almost 6% this month to $3,060, while San Francisco is $40 less. Local news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. Let's bet the markets here. You got NASDAQ 100 just now down by 0.7%. You got Alphabet, though. Those shares are still lower, but off the lows of the session. They reported a weaker than expected third quarter revenue. CFO Ruth Porat warned about challenging times ahead and slowing ad spending. Joining us now with more is Bloomberg's Ed Ludlow, who spoke to Porat. Ed, what were some of your takeaways in terms of what we already knew coming into this, and then what surprised you?
Yeah, I mean, we knew there was softness in the advertising market, right? I think in Alphabet's case, it was just how resilient the core search business would be. It was not resilient. You know, it's interesting in that conversation with Porat, she put a lot of emphasis on the word lapping. You guys know what lapping means? In other words, you know, tough year-on-year comparisons. In fact, I sent our producer Joe a fantastic chart, if we can bring it up. The same period a year ago, Alphabet was seeing incredible growth. But the other way of looking at this is that the environment and the market has changed, right? The other way of looking at it as well is that this is the first quarter since the second quarter of 2020, in other words, the pandemic quarter, where Alphabet has not registered double-digit top-line growth. So clearly the growth story is over here, but the impacts of the slowdown in the ad market, Alphabet is not immune.
And does it get sustained, I guess is the question. Is this a one-off? Is this a kitchen sink? Or is this something we're going to have to live with quarter after quarter? What was the message there, Ed?
Yeah, I think language is important, right? And what Porat said to me on the phone was the macro environment is challenging and it will continue to linger and be challenging. You know, that's not a statement for someone that thinks things will improve in the near term into the last 3 months of this year or indeed into 2023. There's always fighting talk, right? There was a real emphasis from executives about the prospects of AI. You know, they talked about how coming out of the last recession and financial crisis 2008, Alphabet, or what was then Google, rode the wave of mobile, right? Mm-hmm. People engaging with the internet on their cell phone. Well, the next driver of growth and the story they're trying to sell to the street is that the next driver of growth will be artificial intelligence. You look at where they missed in particular, YouTube sales really wide of the mark versus street consensus estimates. Fighting talk there that yes, TikTok is clearly a rival for eyeballs, but there's a lot of confidence in YouTube Shorts and doubling down on video. So there are pockets of where growth can continue, including the cloud, but the bigger picture is not the same as it was the same time a year ago.
So what does this mean then for Meta after the bell today? Then does this revise how we need to look at those numbers?
Yeah, I think we're really worried. And to Guy's previous question, when we had Snap's numbers drop last week and we were kind of shocked by what's happened, the biggest question was how transitory are these issues? Are these issues specific to Snap because of the demographics that Snap targets? Well, we've just had Alphabet and we've seen weakness in its core search business and in YouTube. I think there's a real concern for Meta, which has already reacted in advance to this. You'll remember last month we reported about the headcount reduction because of the changing global economy that Zuckerberg was talking about. I think we're on alert, right? And if you look at the reaction of the NASDAQ 100 in tech stocks this morning, the momentum that we had going into this week is over. Worrying.
Ed, do we know who's not advertising? Where is this slowdown happening? Are there specific areas within the economy that we can focus on?
Yeah, I asked Ruth Porat. I said, Ruth, which geographies, which industries, does this directly relate to inflation hurting the consumer and therefore consumers not searching for higher end products or vacations? And she frankly said, we don't disclose that kind of information. We don't break it down. I think, the telltale signs are that if you look at YouTube, for example, they saw a pullback in advertising budgets, both on brand and on direct response ads, different breadth of different times of advertisements. So, it looks like this is pretty widespread, but I didn't get any any readout on whether this is a European issue like we saw earlier in the year when the war in Ukraine started, or if this is a US issue.
Hey, Ed, do you get the impression that this is a short-term issue or that it could really extend? As in, inflation comes down pretty quickly, everyone already starts to feel a little bit better, and ad revenue can really bounce back? Or do you get the sense that this is more conservative for longer?
I think the sell side's reaction this morning is that the results we saw overnight, not just from Alphabet but from Microsoft as well, because remember they talked about weakness in the PC market being ongoing, does not bode well for the final 3 months of this year and the holiday period in particular. Further afield, remember we went into this quarter knowing the EPS for the big five was going to drop 22% year on year. But if you extrapolate that out into next year, we thought there would be an earnings recovery into 2023 because the bigger picture would recover, the consumer might recover. I do wonder now how much that question is intact, whether we do see a recovery and if this is a more sustained softness, particularly in the advertising market.
Nice work, Ed. Great stuff. Thank you very much indeed. Bloomberg's Ed Ludlow. Fantastic as ever. Thank you very much. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Ritika Gupta. For the first time in more than 2 decades, mortgage rates in the US have gone over 7%. That's according to the Mortgage Bankers Association. Its survey found that the contract rate on a 30-year loan rose to almost 7.2% last week. That extends a strong of steep increases that have hurt housing demand. Boeing's cash flow surged last quarter as it restarted deliveries of the 787 Dreamliner. The company reported $2.9 billion of free cash flow for the third quarter, well above the estimate. That overshadowed more bad news from Boeing's defense division, though. It racked up $2.8 billion in losses due to cost overruns on its aerial tanker Air Force One and other military contracts. And Harley-Davidson posted third quarter profits that beat estimates. The motorcycle maker saw sales rebound from a temporarily production slowdown as Harley was able to raise prices enough to offset higher inflation that padded profit even as sales in its core U.S. market declined. And Intel's self-driving technology company Mobileye raised $861 million in one of the biggest U.S. IPOs of the year. Shares priced above the marketed range. At the IPO price, the company has a market value of about $16.7 billion. Intel will still control Mobileye. And that is your latest Business Flash. Alex.
Very good. Thanks very much. Former U.S. Treasury Secretary Steve Mnuchin said that market watchers were just too sanguine about risks to the economy a year ago and are now being too alarmist about the threats presented by inflation and the Fed's tightening. He made these comments in Riyadh.
you are going to see inflation in the U.S. begin to come under control. Now, it will probably be a 2-year period, but you're going to begin to see that, I think, relatively quickly, and I think people are overestimating the Federal Reserve's actions, just as they underestimated it.
Manouchian speaking at the Saudi Future Investment Initiative, FII, a little bit earlier on. Alex, it's interesting to hear what he has to say. There's an increasing pushback here in Europe as to what the ECB is up to. Remember, we get the ECB tomorrow. You just seen the Bank of Canada go 50 rather than 75. It is growing nervous about what is happening in the economy, the potential for a recession. Maybe it means that it has to slow down at this point. It could still go a long way in terms of raising rates, but maybe just not at the same pace.
Well, and I think that you brought this up before, that what does a pivot actually mean? Because if you're going from 75 to 50, is that a pivot? Because you're still raising 50 bips. A year ago, we would not have even been talking about 50 bips. So you're just sort of slowing down big hikes. Is that really enough for a pivot?
If you extrapolate, 75, 50, 25, none cuts, maybe it's the start of the pivot. But yeah, I hear what you're saying. I think we're getting into some interesting territory here in how we define all of this. I think it's going to get really difficult. But the fact that a major central bank sees maybe the reason not to go 75, I think is interesting at this point.
Well, then also I want to see what the inflationary reaction is off of that, because if you wait and you sort of slow it down and inflation stays high or accelerates, then you have a real problem, and then you're really choosing between weaker growth and higher inflation, whereas now that argument is a bit more theoretical, at least here in the U.S.
And you look at what's happened with the Australians as well. So the Australians, the RBA, only went 25. The market was expecting more. And then you see the inflation data that we've had out today shows, as you say, maybe not a reacceleration, but ongoing inflationary pressures within that economy. We're going to talk certainly more about that. We've got the ECB coming up. That's going to be a huge story tomorrow. Today we're trading 409. We've got the stock 600 up by around 0.5%. You've got the cable rate, which got even higher. We're 116 now. We're up by 1.15%. We've pushed the fiscal events into November. The market seems to be reacting reasonably well to that. We'll talk about the details of that story as well. The pound certainly on the front foot. Interesting earnings coming through there here in Europe. Heineken down by 5.44%. Just warning about what is happening with inflation and the impact that it's having on demand. All of that obviously feeds back into the central bank story. David Cole, Julius Baer's chief economist, is going to be joining us next to set up that ECB story for us. That's next. The close is coming up. This is Bloomberg. Wednesday, the 28th of October, European stocks broadly higher. Banks and brewers firmly in focus. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Let's talk about what's happening in these markets. Let's figure it out. Stock 600 trading at 409, spot 32. We're up by another 2 points today. We're rising by around 0.5%. As I say, the banks are in focus. Deutsche Bank up by 1.13%. We've got Barclays out today as well. We've got Credit Suisse coming up tomorrow, of course. That's the huge event that we've all been waiting for. The bond market's interesting as well. There was a story on the Bloomberg a little bit earlier on talking about the fact that the new Meloni government in Rome is considering a 10 billion euro package to support the consumer and business in Italy. It's interesting what is happening in the debt market. BTP is not really reacting to that significantly. This looks like this is money that has been held over from the Draghi era. Maybe the fiscal stress comes next year. BTPs, Alex, trading at 4.349.
All right, here in the U.S., it looks like we're really turning around here. You got the S&P now up by 0.1%. The NASDAQ 100, though, still in negative territory. In part, you know it because of Google as well as Microsoft. Microsoft at one point falling its most since March of 2020. Also, it's not just those guys. You're looking at Texas Instruments as well. Disappointing quarterly forecast. You notice a theme here. There are concerns now about the weakness in the semi-space that is now spreading from electronics to other areas like the industrial market. So more a broader weakness in tech. I did want to point out, though, the 2-year yield guy. Yields are down by 5 basis points. You did see yields around the lows of the session after the Bank of Canada decision that seemed like it was a hawkish 50 basis point hike. So they pared back what they thought that the market thought they were going to do, but they still talked hawkish. But still, that led to a little bit more buying across the curve within the Treasury market, Guy.
Just some comments coming through from Tiff Macklem actually right now. The Bank of Canada getting closer to the end of the tightening cycle. That, I don't know, that's interesting. That maybe points us in the direction of this kind of 75 to 50 to 25 kind of cycle that we've been talking about. It's interesting he's diverging as well from the Fed, or is he? Or is he just front running the Fed? Maybe that's ultimately where we're going to go with the Fed, but it doesn't feel like it just yet, does it? We'll see.
No, definitely not. Definitely not. But how much can the Fed diverge from that idea? If the data keeps weakening, maybe we're going to have to see that from the Fed also.
Then how do asset markets react to that? It's going to be an interesting run until the end of the year. Let's talk about what is happening here in the UK today. The UK Prime Minister, Rishi Sunak, and his Chancellor, Jeremy Hunt, delaying their economic strategy announcement. That was planned for Monday. It's now going to happen on November the 17th. He also spoke, the Prime Minister, in his first PMQs, Prime Minister's Questions, since becoming PM. This was in the House of Commons a little earlier today.
Well, Mr. Speaker, the Chancellor will set out our plans in the autumn statement shortly, but this is the government that put in place plans which will remain to significantly increase capital expenditure, and even though difficult decisions do need to be made, I think the country can rest assured that we will continue to invest in our future productivity and indeed invest in our public services like the NHS.
The new Prime Minister, an incredibly polished performance. I thought he had answers to pretty much all of the questions that were posed to him. And in some ways, it seems logical that you would shift the dates of the economic event forward a few days. Joe Mays, our UK economic government reporter, joins us now for more. There is some logic here, isn't there? You get a better read from the OBR on what's happening with rates, which are coming down, and gas prices, which are coming down.
Yes, exactly, and Chancellor Jeremy Hunt said that this morning. They want the OBR to have the best information available to make the most accurate forecasts about what could happen to economic growth, so it helps them. You know, market turbulence has gone away to a large extent in gilts in the last few days thanks to their actions, and they want to kind of get the benefit of that in those OBR forecasts, so that's why we saw that delay. It also gives Rishi Sunak more time to speak to his new ministers, new secretaries of state, to agree spending cuts, agree plans. He was never really going to achieve that in just a couple of days, so it helps him politically as well.
So that 35 billion pound fiscal hole, what do we think's on the chopping block to plug it?
So we're reporting today 104 options on the table in terms of spending cuts. I mean, effectively, all government departments are in focus here, and we have, reports out that 10%, 15% cuts might be required to departmental spending. So, the aid budget, that could be in focus, the Justice Department, across the board, Jeremy Hunt is looking for cuts, and no one is really safe at this point.
You watch these things very carefully. What did you make of PMQs?
I thought you're right to say that it was a very polished performance by Rishi Sunak, and I think Keir Starmer's job will probably be more difficult now. Labour has a record lead in the polls, but just on today's evidence, he's up against a pretty formidable opponent now in Sunak, just in terms of presentation, just in terms of competence. It seems like there's been a step up, moving on from Liz Truss, and that's something that Starmer will have to contend with. I think, if you're a Conservative MP, you're feeling a lot happier today based off that performance.
How much leeway, Joe, do you think the market, I appreciate you're the political reporter, but how much leeway do you think the market's going to give Rishi Sunak at this point?
Well, I think the evidence we saw today was that they are already giving him some leeway insofar as that statement delay happened and markets were relatively calm in response. He clearly has restored some fiscal credibility. Jeremy Hunt's done a lot of that as well with junking the Liz Truss plans. So yes, he has some credibility with markets. Whether he can retain that, that'll be the key question November 17th. Are markets convinced by those spending plans? Has he done enough to stabilize those public finances?
Yeah. Joe, thanks a lot. Wonderful reporting as always. Bloomberg's Joe Mays. Thank you very much. Also joining us now, David Cole, Julius Baer, Chief Economist. David, it's kind of the same question to you. How long do you think the markets are going to give Rishi Sunak to deliver, and what do you think we're going to see?
Well, I think the environment has improved definitely so, and it wasn't a quite extraordinary event actually that market rebelled that much as a response to expansionary fiscal policy. So when you compare that, for example, you mentioned it, in Italy, there are plans to expand fiscal policy. There are plans in the Eurozone, there in Germany to expand fiscal policy. You never have seen really markets rebelling that much, so it was probably the wrong focus here on expansionary fiscal policy. It's not only debt per se, that debt is too high. It was the wrong focus which has been set here. And of course the hope is now with a new target or with a new focus on the fiscal policy side that markets will digest that much better than they have done in the past few weeks.
David, the Bank of England meeting is now going to be before this statement that we are going to get on the 17th. How much more difficult is the Bank of England's job as a result of the shift in timing, do you think?
Oh, it remains difficult, definitely so. And in the UK in particular, the coordination between monetary policy on the one hand side and fiscal policy on the other hand side had been pretty poor in the past. And of course, the timing now that the Bank of England, as monetary policy, does not know what fiscal policy will do next, it makes the job more difficult. That said, probably it's a bit more easier to have now somebody on the helmet of fiscal policy, which is more sensitive towards the inflation issue, towards economic policy by itself, and rules how the economy works. And this should probably have a bit of coordination, but of course wishful would be, or helpful would be very much in the UK also to get more coordination of fiscal and monetary policy. If this is possible under the new government, this remains to be seen.
They just can't look like it, but they can do it, but they don't want to show that they're doing it. So the markets are pricing in now fewer than 150 basis points of rate hikes over the next two meetings. That's the first time we've seen that kind of pricing in about a month. What do you think is going to be the correct pricing from the BOE?
Well, I think there's probably still too much of a rate hikes priced in at the Bank of England, and the reason is here that leaving the Bank of England alone, it can only focus on inflation. Focus on inflation of a central bank is always backwards looking. And this makes it more hawkish, probably needs to be more hawkish than otherwise, then really have the confidence that inflation rolls over at some point, also with the help and with the support of fiscal policy going forward. When this remains an unknown, probably hawkish policy has to be priced in at the Bank of England, and we think it's too hawkish.
David, we're starting to get political pushback against the ECB. Giorgia Meloni talking about the fact that the ECB is moving too quickly. Even the French are talking about this as well. Monsieur Macron talking about the idea that this is not a demand-driven inflation story that we're seeing in Europe. Therefore, higher interest rates aren't necessarily the right medicine. I can't remember which ECB president it was, might have been Trichet, talking about the idea that I hear but I don't listen. Do you think the ECB is going to hear but not listen when it comes to these criticisms?
Well, that was actually Wim Dijsselbloem who said that, talking about the exchange rate. So yes, definitely when this critique, although it might be true, comes from politicians' side, that's not particularly helpful as it increases the tension between the two, between fiscal and monetary policy. At the same time, the ECB does not have only to listen to politicians. I mean, they can look at their own numbers. The ECB bank lending survey had been out, the credit numbers had been out, credit and loan numbers had been out, and they all signal that already the increase of interest rates, which we have seen, so 125 basis points, have a sizable effect actually on interest rate sensitive sectors of the economy. This is construction in particular. So really the demand for housing purchases, the loan demand for housing purchases have nearly collapsed following these interest rate increases. And this argument alone would be probably something to consider to slow a bit the pace of rate hikes and really to look first what does it do to the economy and not to be overly concentrated to these inflation numbers, which are a lagging indicator.
David, in essence, you're describing what it looks like the Bank of Canada did today. I mean, they're talking about how there's no generalized decline in price pressures, but they admit that the rate hikes are beginning to weigh on growth and sort of taking its foot off the gas a little bit. Do you think the ECB is going to have to be in a situation where it does that also?
Well, I hope so, but really just to make it very precise here, to look at growth is probably also not ideal, as it's not only to look at inflation. It's really the credit numbers which tell you a bit earlier than when growth has been hit that rising interest rates, tightening financial conditions does something in the direction of slowing growth down or slowing inflation down. And we had these numbers just out. And so this is the crucial transmission mechanism from tighter monetary policy to growth, to inflation numbers. And I think you have to be very sensitive to these numbers. And they are actually different in every country. The reaction of the economy is different in each country to rising interest rates, but it's quite severe in the Eurozone.
75 tomorrow, then what, David?
Well, we think when they really go to 75, they will probably get more of these slowing credit numbers, and this would convince then also the ECB to slow significantly. We think when they do really that much on the next meeting, then we expect 25 basis points on the December meeting only, and probably they have to stop there. They have to stop there because the economy slows. Inflation will slow later, definitely so, but given credit aggregates, slowing economy, this might probably make it very, very difficult to hike further.
David, great to get an update. Thank you very much indeed. David Cole, Julius Baer's chief economist, joining us from Frankfurt. Up next, we're going to get more on the ECB. Mathieu Sabre of BCA Research is going to join us. Before we head to the break, we also heard from the UK Chancellor, Jeremy Hunt, a little earlier. He says that stability is now his top priority. This is Bloomberg.
Our number one priority is economic stability and restoring confidence that the United Kingdom is a country that pays its way.
earnings season is here.
The earnings are starting to pour
The
in.
numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going to cross the wire.
A big beat. Stock is up more than 8%.
Coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch?
That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
So earnings and central banks proving to be an interesting combination today. We just had the Bank of Canada. We get the ECB tomorrow. It's expected to make or deliver another huge rate hike. 75 bips is anticipated. This is the fastest tightening cycle we've seen for that central bank in its history. Joining us now, Mathieu Savary, BCA Research Chief Strategist, joining us from Canada. Let's fold in the Canadian story. Mathieu, we've just seen the BOC going 50 when the market anticipated 75. Do you think we're about to see the same thing happening with the ECB as well? Do you think central banks more broadly are reaching the limits of how aggressive this front loading can be?
No, I don't think this is going to be repeated in the next sessions of central banks hike in the euro area or the United States. And the reason is simply that the Canadian housing market is actually starting to buckle down very rapidly. We also saw the business outlook survey in Canada that was exceptionally weak, which is very worrisome in a country like Canada where household debt is so elevated. So the central bank is starting to see signs that we could see really bad outcome in Canada. So it's, I think, rethinking its strategy.
Okay, so that would make it a bit different then from the ECB. So at this point tomorrow, what would be a hawkish surprise or a dovish surprise for the ECB?
Well, base case is for me 75 bips tomorrow. Obviously, if the ECB starts to get worried, we saw the PMIs that were very poor in Europe, credit numbers that are starting to deteriorate, etc. They could go 50 bips, and that would definitely be seen as very dovish by the market. There's also a lot of questioning about how to deal with the TLTRO, the excess reserves at the central bank, and so on. So if the ECB doesn't act on this front, the market will also take that probably on a dovish, as dovish move.
Mathieu, what does this mean for the dollar? DXY trading 109. You've got the pound up. You've got the euro up. Are these moves going to be welcomed by the Bank of England and the ECB, do you think?
Yeah, because the weakness in those currencies have contributed to increase the imported inflation that has been the main driver, especially in the Eurozone, of overall inflation. So yes, I think they are welcoming the rebound that we've seen in their currencies over the course of the last few weeks. Generally speaking, the forces are becoming slightly more dollar bearish. The expected interest rate differential between the US and Europe on average is diminishing in the money market. So that suggests that there could be a little bit more decline in the DXY that will be very favorable to the euro and the GBP.
In terms of technical stuff the ECB has to contend with, how do they need to shift the transmission mechanism from their rate hikes into the real economy?
Well, the rate hikes will affect the real economy via the tightening in financial conditions that has been shown in terms of higher yield, wider spreads, lower stock prices. So that definitely has an impact on economic activity. The second element is that as rates rise, the demand for credit will continue to deteriorate, which is what the bank lending survey is already showing. So we are seeing really the policy of the ECB starting to have an impact, and this impact is really working because the global economy is weak and Europe is very affected by the fluctuation in the global business cycle.
Mathieu, what are you reading into the earnings season that you're seeing develop thus far? You've got Microsoft seeing a significant slowdown in corporate investment. You've got Alphabet seeing a significant slowdown in advertising spend. More broadly, you look at what is happening here in Europe. You've got names like Heineken talking about the fact that inflation is having a meaningful impact on consumer behavior. People are drinking less. What do you read into all of this? What's the macro signal that we should be taking away?
Global growth is weakening. It's as simple as that. And it's a reflection of the tightening in global financial conditions. Yes, it's true that inflation also has added to this problem because household real income are being squeezed very rapidly, especially in Europe right now. But generally, yeah, I would expect economic activity to continue to decelerate. The PMIs have not bottomed yet. And this means also that earnings estimates in the United States as well as in Europe have more downside over the course of the next few months, at least until we see clearer sign that global economic activity has done its deceleration, and we're not there yet.
So at the same time, though, we're also looking at governments having to pump a lot more money into their economies, like Germany with their 200 billion euro plan to help offset high energy prices. We're seeing something potentially similar over in Italy as well. This feels very much in some respects what UK under Liz Truss was trying to do too, where you have more money being pumped in, subsidies in some ways, and at the same time a hawkish central bank. Do we get to the same point of conflict as the UK did?
It's always possible, especially when it comes to Italy, where we're going to get negotiation in the next few months between Brussels and Rome over the fact that Giorgia Meloni is not very keen on the type of structural reform that are demanded of Italy to access its 200 billion euros under the NGEU program. But generally, I think we need to differentiate between the UK and the Eurozone here. First of all, the current account deficit of the Eurozone is very small, so it's less reliant on foreigners and therefore has less to contend with the tightening in global liquidity caused by the strong dollar and the higher US interest rate. And secondly, and probably even more importantly, in the Eurozone, inflation is mostly a reflection of higher energy prices and imported. So it's the supply shock, if you will. While in the United Kingdom, we were seeing sign of strong demand-driven inflation in terms of rent and wages that are a lot stronger than in Europe. So the very inflationary budget that Liz Truss had was only fanning a problem that was already existing, which doesn't exist to the same degree in Europe. So I think Europe has more, the continent has more leeway than the UK had a few weeks ago.
All right, Mathieu, thank you very much. Mathieu Sevre, BCA Research Chief Strategist. Thanks so much for joining us. Great to get your perspective. This is Bloomberg.